My guest today is Landis Williams. He is an Orange County raised mortgage banker and the owner of Your Favorite Lenders, a company that's been helping clients achieve in their home ownership and investment goals for the past 7 years. Under his leadership, the company has been recognized as the best mortgage company by the OC Register for 2 consecutive years, solidifying its reputation as a top-tier lender in the region. With a deep understanding of the mortgage industry and a commitment to exceptional service, Landis and his team are on track to become one of the premier mortgage companies in Orange County. Beyond this work, Landis enjoys fishing, golfing, and spending time with his family. Please welcome Landis.
Thanks for having me, Eric. I appreciate it.
Yeah.
Love to meet with you always. I know we mastermind, after our meetings all the time. So it's good to, put it out there for everybody.
Absolutely. Absolutely. I wanted to kick it off by asking what inspired you to start this lending company?
So realistically, me and my business partner, Garrett, we started as just normal loan officers in a company. We were, banging the phones, doing 200 to 300 outbounds a day, working for, a larger mortgage bank. Realized, it's fairly easy to do this. I kind of met with the higher ups on the weekends because nobody was working on the weekends. I'd be the only one in there. And I would ask questions. I was just curious. I kind of got a better understanding of what they're doing on the back end and what I'm doing on the front end, like what my work up front leads to in the back. And I figured that out. And then that was one piece of the puzzle. After that, we went to go work for a mortgage broker, totally different realm. Banks are very strict. They have, a couple set of guidelines. If you don't follow to that, you don't get a loan.
Yeah.
With mortgage brokering, you're working with hundreds of different banks. So if there's an odd situation, you just need to know the full story from the client. That's why I really always ask for transparency. I'm like, hey, I work for you. I don't work for the bank. I'm just trying to find a loan for you. So in that instance, we partnered with this mortgage broker. Luckily for us, he was about to have his second kid. So he was out of the office a lot. So he gave us a lot of the reins to kind of learn, make relationships with lenders, and kind of push the business forward. And then from there, we pretty much learned it all. One of our biggest things that I kind of look back on and I'm like, I'm really happy that we did that is, so we had a base salary there, which is pretty uncommon for mortgage lending, but we always knew we wanted to have people underneath us. We wanted to grow a team. So what we did was instead of take our base salary, we hired people with it. So we essentially were commission only because we transferred our base to our team members to allow them to have, a base to grow and learn the business while still making some money. And we got the managerial experience by training them, bringing them to where we need them to be. And then at that point in time, we're like, we have both sides of the puzzle. Let's start Your Favorite Lenders. And that was about 7 years ago and haven't looked back since.
Is there anything that you specifically focus on? Obviously, it's residential. Do you also do commercial or just residential?
Yeah, so we actually have multiple different departments here.
Yeah.
The biggest ones are our residential team. They help first-time home buyers, anyone looking to buy a residential piece of property, whether for, first-time use, second home use, investment property. Then we have our investor division, where their only focus is to help people acquire properties that need, renovation. So they'll do a fix and flip loan for them. They'll do what's called a DSCR loan, a debt service coverage ratio loan, where as long as the rent covers the mortgage payment and you have 20% down, the bank's going to write you that loan. So those are the loans that the investor division handles. We also have our small business loan division, and then we also have our commercial loan division. So those are really the 4 pillars of the company and the main loans that we do offer. But pretty much any financing that you do need, we do have the ability to offer. One that's been pretty popular recently with business owners is merchant cash advances. So they have, credit card sales and they need the money up front a lot of times, or they need an advance on it. They know that, hey, every month I get $10,000 in credit card sales, but I need $5,000 for new inventory to drive more sales. We can go ahead and land on that future projected income that they're going to get from their credit card sales.
Got it. Is there any big challenge that you faced in the early days, starting this journey?
I would say the biggest challenge pretty much any business owner is going to face is the management of people. that's what I always found to be the most difficult part. The job itself, I know inside and out, but every individual person is different. So what I need to do to, motivate one will demotivate the other. So really understanding like the human aspect of people management has been the most difficult part, but it's also been the most fun part.
Yeah. Now you got into this business after some of those crazy, because I handled a lot of fraud and scam cases. We actually handled one recently, but in the mid 2000s, where people were selling credit profiles and the loans were it was just like the Wolf of Wall Street for lending. And,
Yeah.
and it seemed like it was just going nuts. And in Orange County,
It
it was big time.
Yeah.
I mean, we had people that came out from Detroit to sell a bunch of credit profiles that we got, and then we ended up working our way up to people that were doing some crazy identity theft and fraud. You weren't part of that phase. You came after, but have you heard about that type of stuff that was going on?
Yeah, so that is in the industry we call the subprime days.
Okay.
I'm a younger guy, so I was actually a child when that was going on. But some of the stories I hear is absolutely insane of, what was going on. Selling of credit profiles.
Mm-hmm.
Some of the guys say like to edit documents. They didn't have Adobe like we have now and ChatGPT and all these crazy softwares, but they did have whiteout and a fax machine.
Yeah.
So they would white out, what they didn't like, correct it, and then fax it through 3, 4, 5, 6 times so that you can't tell, because with a fax, you lose quality as you start sending it through. And that was just something like the low-hanging stuff that they were doing to get these loans through. Then there's these exotic products like negative amortization, where that's essentially saying that, hey, the market always appreciates, real estate always goes up. So let me give you an augmented lower payment, and we're just going to put debt on the back of this loan. And, you're going to make money in the long run because real estate always goes up.
Yeah.
When real estate eventually went down, those loans went belly up. So that was some of just the minor stories that, I've heard from the past. But
yeah. And obviously you guys are on the up and up, and you do handle creative loans where we've had family law cases where I've referred some people to kind of help out people in those types of situations. Because in Orange County, real estate is just, I don't know if you have the stats in terms of nationwide, but it's
up there.
Yeah, it's up there.
Some of
It's, yeah.
the most coveted real estate in America.
Yeah. So you guys handle some of those creative loans as it relates to people getting divorced or different types of things, right?
Correct. Yeah. Really, the main loan that we see when a divorce comes through is generally just a standard conventional loan, backed by Fannie Mae, Freddie Mac. Where we really shine is that most people structure those loans as a cash out loan because they need to take some equity out of the property to pay off the spouse. But there's a little known guideline in the Fannie Mae and Freddie Mac selling guides that allow you to consider it a rate and term if it's a court-ordered payout. So they go to court, they get their divorce. The judge says, hey, husband needs $300,000 from the property. You get that court-ordered document, you submit that to the underwriter. That's now a rate and term loan. And I can save them tens of thousands of dollars in interest over the life of the loan and also get them a lower payment, better interest rate, just by that little known fact. So I can at least 10 or 15 loans every year. I get that scenario in.
Yeah.
I structure it in a way where it makes the most sense for them. The other loan officer calls them and is like, hey, he's pricing your loan out wrong. You're never going to get that done. It's a cash out loan. You're taking equity out of the property. And, as respectfully as I can, I just let them know, hey, not every loan officer is created equal. It's really about the knowledge behind it all. And I've done this in the past. I know that this works. You could go with them, but I've got the better deal. I've got the better knowledge. Mm-hmm. You make that decision for yourself at the end of the day.
So I think this is relevant right now, and you probably get to ask this a lot. What's going to happen with interest rates right now?
I think that interest rates will fall in the future. I'm not saying it's an immediate thing. Maybe in a year or so, you'll start to see them come down. Really, the big pain point right now is inflation and the job market. So right now, they're concerned a lot about inflation, but the current administration is working to lower the cost of energy. everything needs to get here on a boat, train, or a truck. It's just how logistics works with all of our supplies. So you can drive down the cost of the shipping, should drive down the cost of the items, which then drives down the cost of the consumer, which eventually leads to lower inflation numbers. With that, the Federal Reserve has the leeway to go ahead and lower rates. So that's my prediction, is that it's going to take some time. It's been 2-3 weeks since the new administration's taken over. They've, love them or hate them, they're making moves. They're changing things up. So what we'll see in the next year or so will really kind of give us an idea of what the future will look like.
What do you think is going to happen with the devastation that happened in LA regarding those neighborhoods, construction, loans? I believe you mentioned something recently about it, but what do you think is going to transpire in the next couple of years regarding all that?
I think there's going to be major redevelopments. I think that zoning is going to be looked at very differently, where historically Southern California has been low density, single family residence zoning, throughout the majority of Southern California.
Mm-hmm.
Now we have a housing crisis. We've got this freed up land, and I think that they're going to really consider making high density living, making more apartment complexes, making more condos. Is that good for the average consumer? We'll see. Apartments don't help people achieve home ownership, but they do provide housing. So there's a give and take with that. And I think that a lot of these people are fed up with the fire dangers that they've come across the last 10 years or so. I mean, if you're 70 years old and you just lost your house, are you going to try to rebuild and go back there? Or are you going to take that insurance payout and move somewhere else? If I was in that position, I'm taking the insurance payout. I'm, selling the land to a developer, and I'm out. I'm moving to Orange County, or I'm moving somewhere where fires are less prevalent, maybe middle of America, lower cost of living at that point.
Would you invest in California real estate?
That's a tricky question. It depends on what I would be looking at. Would I invest in a single family residence as a rental? No. Would I invest in development deals? Yes. I think that is where a lot of money can be made in California, is taking something from nothing to something. If it's already a structure, it's already there, it's got established tenants, you're really banking on appreciation. Where I'm at in my investing life is I'm not really looking for appreciation. I'm more of a cash flow guy at this point in time.
Yeah.
So as a developer, I would look into it. As a long-term hold, I probably wouldn't buy it here. I would be buying in the Midwest or the East Coast, really looking for some cash flow, less appreciation, and just let the money work for myself in that aspect.
How about somebody like a single person that's just getting into their career, or a newlywed couple with kids? Sometimes you hear people are priced out of the market. Does your company come up with some solutions for some of those folks? Or is it just maybe their family's helping them or something like that?
A lot of what we're seeing right now is a lot of family help. We're seeing a lot of gifts from parents. Hey, here's $100,000. Here's $200,000. Help you guys get started. And that's for just a basic starter in Southern California. The ones who don't have the help, they are becoming more realistic with their goals and their aspirations. They're understanding that this is this is a stepping stone. This is not you get your dream home. Unfortunately, we're not in the state where that's possible. If you want to go to Texas, $300,000-$400,000 gets you a beautiful brand new build on an acre. But if you want to be in Southern California, $400,000-$500,000 gets you a 900 square foot condo. But what I've found is that you don't need all these things that you think you need at the end of the day. When you really break it down for people and you say, okay, why do you want 4 bedrooms? Oh, because, my family might come over. Well, in the last year, how often has your family come over and stayed at your house? Oh, they haven't. Okay, so maybe a 2-bedroom would work.
Yeah.
And it's just kind of bringing the reality of things to them, and just let them know that, it is a process. Getting to your dream goal is always going to take some time. There's always going to be some discomfort through it all. And, really changing their frame of reference to this is where I want to be, and this is where I need to be to, this is what's actually attainable, and this is the steps in the process to get to where I want to be.
Yeah. I know we talked about scams. I wanted to get it from your perspective in terms of like some of the government loan scams or the high pressure tactics or some of these other things that I'll get into. But what have you seen recently that has been kind of prevalent in your industry? What to look for, for people that are trying to get a loan, and you just never know,
Yeah. What is super prevalent in the industry right now is offshoring of call centers, things like that. So you're going to get a call from somebody who's claiming to be a representative of XYZ, and they're going to have some type of foreign accent, and you're not going to really know who they are. That could be for the better or for worse. That could be a cost-saving measure by a large institution, and that in turn gives you a better deal on your loan at the end of the day. But it could also be a nefarious character trying to play off of the fact that this is, a common occurrence now, trying to get your personal information. So what I always tell people is be aloof on the phone. Take the call if this is something that you're interested in. Ask, clarifying questions. What company is it? What's the company's NMLS number? That is the federal license number that the government gives the lending institution. What's that? Where's your company located? Is there a physical address for it? Look them up on Google. I really strive to get as many Google reviews as possible, have clients take pictures, post it on our Google page. That way, when they come and they look, they see, oh, they do have a physical address over here in Anaheim. Look at all these happy families taking pictures at, the home that they just bought. And there's 150 five-star Google reviews, claiming that, these people are legit. They help us out. And then, the representative that's speaking to you is going to be like, your loan officer is going to be XYZ. They go and they look at these reviews. They see 5-6 reviews for that guy. It all kind of checks out at the end of the day. I would be hesitant to share my information just over the phone. Like if they ask you your date of birth or your social, with the way that technology is going right now, I've kind of pivoted the entire company to, hey, here's our secure online application. They create an account. It's 2-factor authenticated. They go in there, it's encrypted, and they plug in all their most sensitive information. Date of birth, social security number, their previous addresses, how much money they make, where they work. Pretty much their entire identity at the end of the day is what we need to get a loan done. And, that would be my biggest fear as a consumer nowadays is getting my information to the wrong people when I'm looking for a good or service that is essential. Everybody needs housing. Everyone wants to buy a house. So that's really what I would look out for scam wise right now.
And then that case I was talking about, it was they filed a fraudulent deed.
Yes.
And so what could prevent something like that? I mean, obviously I think the lawsuit got thrown out, but title insurance or going through, making sure you're with a great lender that does things right, great employees. But I mean, there's going to be people scamming all the time, but what should an individual look for going through the process, making sure that everything, title insurance and all of that?
Yeah. So there's, like you said, there's always going to be scammers. There's always going to be somebody trying to take advantage of a situation. With the advent of technology and how easy things are now, you could e-record deeds. You used to have to go take it down to the office, show your face, get a stamp. So I would say it's probably less prevalent then, just because people didn't want their identity to go out there. Like, that's the guy who came and he did this. Where now you could just record it online. But that is the purpose of title insurance. So you will get a loan estimate when you apply for a home loan. And there's going to be some fees on there. And you're like, title insurance, escrow fee. Why do I need this? This is exactly the case when title insurance would come in to play. Because if there's any claim to your ownership, that title company verified that the chain of ownership has been complete and true all the way through into your purchase of the home. And then at that point, they issue this policy. It's going to cost you a couple $1,000s, but that protects you as long as, you don't change ownership interests or anything like that. There's no change to the actual transaction itself from the original purchase date. So if anybody comes back and says, hey, Eric, you bought this house from John, but I've owned this house for 45 years. I don't know how he sold it to you. And if it does turned out to be the case, that's fraud happened in between, that transaction, they would pay out the seeker of the property.
Mhm.
Okay, hey, this is the fair market value. Here's the money to make it right, because they did their due diligence. They signed off to saying that everything's true and correct on this, and they took your money to guarantee that. So title insurance, I would always get it, even if you're buying cash. I would reach out to a title company.
What are lending companies that we'll say are legit online? Are there some companies adding fee? Because that packet that you fill out, whether you're doing a HELOC or a loan or whatever, is huge. And you're sitting in front of a notary, and you're just going one by one, and nobody's, unless they're a fantastic speed reader, nobody's seeing everything. Is there some people in your industry that are just less than transparent? And if so, what are they doing? What should the consumer look out for?
Definitely. In every industry, there's going to be somebody who tries to cut corners, not disclose everything. Realistically, the meat and potatoes of any loan is going to be your loan estimate and your closing disclosure. That's a government requirement form that has a breakdown of everything on there. It's going to tell you the loan amount. It's going to tell you the interest rate, whether that interest rate can adjust at any point in time. And if it does adjust, what are the caps on that adjustment? It's going to let you know there's a prepayment penalty. It's going to let you know that your principal and interest payment can never change. It's always going to be the same because it's amortized. It's going to let you know that the only thing that can change is potentially your homeowner's insurance and your property taxes, because at the end of the day, insurance companies change their underwriting guidelines, their premiums, that may go up. Property taxes, they get reassessed, as homes sell, your home appreciates. And then down below on your second page, it's going to have a complete breakdown of all the fees. So really what the lender can control and what you can kind of control is going to be Section A. That's the lender charges. That's the section that if you're going to be a savvy shopper, that you really want to focus on. Sections B and C are really like boilerplate template fees that, depending on the title and escrow company that you're going with, that's going to be the fees. Whether you go with this company or the other company, they're pretty standard across the board. So Section A of the loan estimate and really understanding your loan estimate is going to be the biggest thing to make sure you get a good deal. I always tell people, whether you go with me or you go with somebody else, if you go with somebody else, I'm happy to look over the loan estimate for you. I'll point out what's going on and be like, hey, this looks a little strange here. This looks a little high. Maybe talk to them about it. Because at the end of the day, just because I don't win that deal, if I do that for that person, they're going to refer their mom, their sister, their brother, whoever to me to make sure that, I do the same great service for them. And maybe I do win that deal. And at the end of the day, grow my business in that manner.
So obviously that sets you apart from your competitors. What else sets you guys apart from your competitors?
Well, really, our big thing is, put yourself in the shoes of the client. What would you like done to you? So, there's been instances where there's a mistake made and we don't make any money on a transaction or lose money on a transaction because it was our fault. So I would say that integrity and really putting ourselves in the shoes of the client and understanding, if it was our fault, we need to make it right at the end of the day. That's really our distinguishing factor. And we try to become friends with all of our clients. At the end of the day, I want them to call me if they get something weird in the mail, because that happens. Like when you buy a house, you're going to get all these weird mail that look official that say, you need to do this or this or this, you qualify for that. And I just want them to take a picture, send it to me and be like, hey, I don't know what's going on with this. Can you point me in the right direction? And that's, the job doesn't stop after I give you the loan. It's, from start to end. When you sell the home and you want to buy something else, I'm there for you as well. Or even if you just stay in that house and you don't do a refinance or anything, if you have a question about anything, hey, I need a good roofer. I need a good this. I need a good that. I'm your guy for that.
Got it. How do you manage, risk when approving some of these loans?
So we always do a preliminary scrub. Loan officers, they grab the documents, they look through it, they calculate income, make sure everything looks legit. And at that point in time, once they have a complete file and it's ready to move forward to a lender, they go ahead and they request a processing review. That pings me or my partner Garrett, and then we go through and then we do another scrub. of everything to make sure that it looks good. Everything is as it should be. Once it passes that second scrub, it then goes to the lender who has their underwriter review the file. And that's really like our third final in-depth scrub of the file to make sure that everything's legit and good to move forward. So we really do it as like a 3-step process. We have the initial, we have management review, and then we have the bank's actual underwriter who's going to be issuing the loan review that as well. And if everybody signs off in that thing, in that aspect, there's only so much you can do. There's always going to be some super genius out there who figures out the system. But as long as we do that, we feel good that we're doing as much as we possibly can to protect everybody.
And technology is playing probably a huge role in that to keep it streamlined and.
Correct. Yeah. So there's a lot of technologies out there that you can, upload documents to, let you know if it's been edited, let you know if anything's been changed, if it's, original. Opening documents in Adobe. There's a little tab on the side that will let you know if something's been changed. Not a lot of people know that.
Got it.
So, that's also something that we do when we do that, initial scrub is, you just look at every document for authenticity. At the end of the day, like our professional license is on the line. No one deal is worth losing your license or jeopardizing the company as a whole. Now, I've got a lot of young fathers here that work for us. And the last thing that I would want to do is to, allow something or miss something that puts them in a position where they can't provide for their families. So that's our perspective on that.
On average, if somebody what would be the turnaround time? I mean, I know you guys handle some unique situations. We spoke about the family law. But what's the turnaround time, maybe in a perfect world, just to get the loan?
If you're a very clean borrower, great FICO score, great, job history, employment history, all that, you can get a loan closed in as fast as 10 days. That's the legal requirement. There's a certain amount of days after you get your initial disclosure package that you have to wait before your closing disclosure can go out. And after your closing disclosure goes out, there's 3 days before you can fund on that transaction. So in all, it comes out to about 10 days is the absolute fastest that you can close like a primary residence purchase.
Are there any mistakes that borrowers make, during the process?
Biggest mistake is going to look at homes without being pre-approved. That's, a heartbreaking call sometimes. They go and they find this amazing home that they love. They sell their family. They take their family and they're like, look, this is going to be our house. And then they come to find that they can't, afford that home.
Yeah.
Another one is opening new lines of credit or debt during the process. They get so excited. They're like, I've been approved for this home. We're working towards getting clear to close so that, we can fund this loan and buy this home. And they go and they buy a bunch of furniture for the house. Or they buy a new car for their wife because they want to surprise them on move-in day. Like, oh, not only did I get you a house, I got you the new car as well. And that's a liability. That's something that we have to account for on your monthly debts. And sometimes, especially over here in Southern California, people are stretched very thin on their debt to income ratio when purchasing these homes. It's not like back in the day where 30% of your income can go to a house. Normally it's 45 to 50% of your income is going towards your house.
I know there's on a lot of this new construction, they'll have like a salesperson there. Do you always recommend, and I know this is more real estate side, but your experience is pretty vast, but do you always recommend going into deals with a real estate agent, or, say you go to a new home construction, is it better to use that individual or maybe some of the options that they have?
I would always suggest people to go with a trusted agent. Interview a couple different agents. Make sure that, one, they fit your personality, because there's some fast talkers, fast movers, and you may, be a first-time home buyer. You don't understand all this, and if they're not open to slowing down, explaining things to you, that's not going to be a good fit. And then also with new builds, there's a lot of intricacies with, a lot of times there's what's called like special assessments or Melrose, very popular in like Irvine, South County, where these developers, they don't have the money to go ahead and build the infrastructure, the roads, the pipes, everything like that. So what they do is they take a loan from the city to go do that, because the city is going to collect property taxes. And what they do is they increase your property taxes, marginally. Normally, property taxes are about 1.2% of the purchase price. But on these new builds, they may be 1.5%, all the way up to 1.9%, which, in your head, you're like, oh, it's not even a full percent. Like, that's not a bad deal. But then when you do that percentage on a very large number, it comes out to tens of thousands of dollars every year, which, then really changes your payment. And that's going to be there either forever, but generally it's usually for 20 to 30 years.
There's no end date, though. It could be whenever, right? Or do they have?
There are end dates on some of them. Like Riverside County, a lot of like those new builds that came up in like the early 2000s and the 90s, those are starting to sunset. So those property tax rates are going to go back down, which, in my opinion, that drives the value of your home. Because, if you used to have to pay an extra $300 a month property taxes, now you can pay an extra, call it $50,000 purchase price, because you're okay with paying roughly that same amount. You're just transferring it from property taxes to actually, an increased value of your home.
What do you think is going to happen with the insurance, home insurance rates? And some companies have left California, right, because of the fires and stuff?
A lot of companies have left California. I think that with everything, there's opportunity. Some will leave, some will come in. They'll seize the opportunity. They'll underwrite better. They'll do more, diligence.
Yeah.
I think that they had it easy for a while. They're just issuing policies. Okay, cool. It was pretty safe. Your house generally doesn't burn down. If you look, most houses are, fine. They're 50, 60, 70 years old. Very few claims on it. But now with the increased risk, wildfires, natural disasters, things of that nature, I think underwriting can be a little stricter. And with that, policy premiums are going to go up, but there's going to be somebody in to come and fill the void. California is just too large of a market to leave untapped.
In terms of individuals and small businesses and things like that, but in terms of somebody's credit score, what do you see the best way for somebody to improve that?
Best way. So we'll look at it in two different ways. So if I'm just getting started, what I would do is I would go to a credit union. If I'm 18 years old, this is exactly what I did. Went to a credit union. I got what's called a secured credit card. So what they're going to do is they're going to say, how much money do you want to deposit into this account? I'm going to deposit $500. Mm-hmm. Okay. So now you have a credit limit of $500, and they use your deposit as collateral. So then you go ahead, you swipe your card, you put gas in your car, you go out to eat with your friends, and you pay it off. And I did that for about a year, and then I was able to get a normal credit card. And then I did that again and again and again. And that's really how I built my credit. And by the time I was, in my 20s, I had 800 FICO score. I had large lines of credit. I was able to access to, if I wanted to, take out a business loan. If I wanted to do anything. Luckily, we were able to self-finance, your favorite lenders. But that's how I do if I was, just starting. And then if I was, more established and I was trying to boost my credit score, I would try to pay down my debt as quickly as possible. There's a famous guy out there, Dave Ramsey. Not a lot of people always vibe with him, but I always tell people his advice may not be for you, but it's not bad advice.
Mm-hmm.
Live on less than you make, and don't have debt. None of that is bad advice. He also says, hey, don't have debt on your home. I think that mortgages are good debt. They allow you to own a piece of property and get in it without having to save up hundreds of thousands of dollars. But I would go through his debt snowball. I would pay down the smallest balances first, and then I would start working up towards the biggest ones, and then really just attack it. I would live below my means. I would look at a second job as well. I mean, it's not going to be comfortable. That's what a lot of people are like. They want it to be comfortable and they want to be in a better position. I don't know if there's ever been a time where you could be comfortable and get yourself to an elevated position. I can say that I'm constantly uncomfortable, but I have grown to like being uncomfortable, growing and pushing, not knowing like, okay, is this going to work? But just believing in the process and knowing that I'm doing something that I believe is going to lead to, something better in the future, just committing to it. So that's how I would boost my credit score if I was, midway through my journey. I was trying to really hunker down. I would pay off all my debt. And that really is, how I've gone about it personally. A lot of people will say, "Oh, you leave a little balance on there. They want to see like there's a small balance." In my eyes, you're just giving away interest to the bank.
Mm-hmm.
Like I've never carried a balance on anything, and I have a phenomenal credit score.
Do you think people should freeze you can do it for free. You can get your credit report online each year for free. Do you think people should freeze their credit when they're done, maybe securing those credit cards and things like that?
Yes. So I actually freeze my credit personally. I think that if you're not using it, there's no point in having it open. If you're wheeling and dealing, you're a real estate investor, you're buying this, you're selling that, and you're always, utilizing your credit, keep it open. But if you're just a normal person, when you're going to apply for a credit card, when you're going to apply for a home loan, all these things, and there's no need to have it open. If you want to, because it's convenient, you don't want to make the phone call or create the app to, unlock it, by all means, yourself open to identity theft, which I'm sure you've experienced.
Mm-hmm.
A lot of people who are reaching out and like, this is not me. Like, how do I fix it? I'm not an expert on it. I'd like to hear your opinion. I mean, a lot of times they're kind of stuck in a tough spot for quite a long time until eventually it works itself out, or a lot of times it doesn't work itself out.
Yeah, it definitely causes some pain for people. And I always tell them, get that credit, report, analyze it. One case we recently handled, it was, theft from, it was ATM, bank, a lot of transfers, ended up being a family member, and they admitted to it after we interviewed him. So you got to look at that circle of friends. You got to look at maybe people that work on your house or had access to some paperwork or your cards or whatever. But yeah, you got to take that stuff into your own hands when you're, when you establish that credit and then lock it and try to prevent it, because it ended up being too much volume for law enforcement to handle. I mean, it's too much. So you got to take that stuff into your own hands. And I think it's kind of slowed down because people have gotten savvy and companies have helped out people with that stuff. But there's always somebody looking to take advantage of somebody else. In your industry, what do you think is going to happen in the next 5 to 10 years? I think in the mid 2000s, you saw probably companies getting weeded out, maybe people getting indicted and for taking advantage of people. But what do you see in the future?
I always think the future's bright, especially here at Your Favorite Lenders, where every day, we're working towards, growing, being better. I always tell my loan officers, like, every day I'm looking to put new opportunities in front of you guys and ourselves to become a better company. And, a lot of companies have taken their foot off the gas of these last couple of years with the interest rates hiking up, demand for housing kind of, I wouldn't say slowing down, but people are putting it off because the payments are so high, or they're concerned that the rates are too high and that they're not going to be able to refinance later on. And I saw an interesting statistic the other day. It was like 74% of real estate agents didn't sell a home last year. And if you look at an industry as a whole, they're the other half to a loan officer. You need a real estate agent and you need a loan officer to buy a house. And if 74, almost 3/4 of that industry didn't sell a home, the market's consolidating. Those guys are leaving the marketplace. And then there was another statistic. There was like 300 or 400,000 loan officers during COVID when rates were super low. Now there's about 90,000 of us. So again, consolidation. But with that, that weeds out a lot of the bad apples, the guys that are not disclosing properly, that didn't have the sound business practices. So I think that peaks and troughs are natural in any industry, and I think that it really allows the best businesses to sustain themselves and then grow. We grew year over year, even during a slow market. Mm-hmm. Is it as fast as we would like? No, but it's the constant focus on growth and the outlook of, I think that I trust in the U.S. economy. I think that in the future, things are always going to be better than they were in the past. If you look at the last 100 years of history, stock market's gone up. If you look at it the long term, always going up. If you look at where your parents started, their lives were drastically, I'm not saying they were terrible, but they are worse than where we're at today. We can go on our phone, we can ask ChatGPT, hey, here's a picture of my fridge. what should I make for dinner tonight? And it's going to tell you like 10 different recipes. They were trying to figure out how to get food or how to make sure that it doesn't spoil in the fridge. They were still getting ice put into their refrigerators. So I think that just having a positive mindset on that the world is, it's an incentive for the world to get better for everybody.
Yeah. On that note, we've talked about it a little bit, but I wanted you to expand. What's one piece of financial advice you wish more people knew?
The biggest piece of financial advice that I wish more people knew, which I think they do know, it just isn't something that they want to hear, is just live on less than you make. If you make $50,000 a year, live off of 45, live off of 40, live off of, as little as you possibly can while still having a good life. You only get one life. You want to make sure you experience things, you want to do things, but you also have to plan for the future. The worst thing that I see is, somebody in their 40s or their 50s reaching out to me saying they want to buy their first home and they don't have any money saved. That's very concerning for me, just on like a personal level with them. Like, okay, we can't get you into this home right now because you don't have a down payment or this or that. But like, what's your plan for the future? Because you only have 10, 15 years of your working life left.
Mm-hmm.
You need to do a drastic 180 to make sure that you can live comfortably and with dignity in your retirement age.
Yeah, you got to start early. I mean, I'm with our kids. We kicked it off. I told them, because you don't want to be looking back at that age and, I didn't do anything. You've established, you and your business partner have established a great thing here. Is there anything that you'd give your younger self, any sort of business advice that, oh man, I wish I would have done that, or you just on a good trajectory?
I think we're on a good trajectory. I think that some advice that I would give myself and that I would give anybody, and I kind of brought it up in our networking group. Pick 3 words that you want to guide, yourself every year. This year we chose accountability, consistency, and speed. I think the largest hindrance to personal growth and business growth is lack of speed. Is if you have an idea, act on the idea. If it's a bad idea, cancel it. Just be quick with every decision, because time is finite. So if you waste too much time being analytical and not moving things forward, you could miss out on this, great growth. And you're going to make bad decisions. I can tell you right now, I've, wasted tons of money on bad decisions that we thought would work. But at the end of the day, we learned from it, and now we're better from it. And we're growing, year over year. That's a big advice, is speed of action.
Yeah, you got to jump in the deep end. You can't. And just like you mentioned earlier, in terms of, being a business owner and taking those risks, I mean, you got to be comfortable with the chaos. Your back could be against the wall every day, and you're always dealing with something. So I really like, what you've established along with your business partner is amazing here. And so I really appreciate you sitting down, talking about everything, the scams, your journey, all of it, and what you're only like, 22 right now. So man, you've got a lot ahead of you. So thank you very much for coming here.
Thank you for having us on. I really appreciate it. I always like meeting with you on Wednesdays. For those of you who don't know, me and Eric actually met at Le Tip in Orange. We're a business professional networking group. And, I came in one day. He was the first one to approach me, say hello to me, introduced me to people there, and we just instantly connected. And from there, we've had a great connection. We talk every week about business, how we could help each other grow. And, I see big things happening for us in the future. And, I love connecting with you, and I'm happy to have you as a business associate and a friend.
Absolutely. Likewise. Thank you.